existing bond fund strategies follow a time horizon or a benchmark, and that's fine if you have a view on the market. Time horizon strategy means that sometimes a strategy will classify itself as short-term or conservative and invest mostly in short-term securities, such as those maturing in 3 years or less. And long-term strategies tend to invest in securities which will mature in more time than 3 years. So longer-term securities, carrying a little bit more risk. So these things are good for specific purposes and when you have a view on the market. For example, a short-term fund investing in 3 years or shorter securities will perform better when the market is falling or bond prices are falling. The short tenor of these securities makes it less vulnerable to the changes in interest rates. So when interest rates go up and bond prices go down, the price losses that you take on these bonds are not as bad. And this is what happened in 2018. A fund with short-term exposure did not fare as badly in a time when interest rates were going higher. But conversely, when interest rates fall, a conservative fund invested in securities up to 3 years also doesn't enjoy much of the gains, which is what happened in 2019. When the market was rallying, the short-term funds were not able to capitalize on the gains as much as longer-term funds. Now, benchmark funds are usually longer-term funds. As I mentioned earlier, longer-term funds will typically hold a higher concentration of long-tenor bonds. These bonds are more sensitive to changes in interest rates, and because of that, they tend to fluctuate a bit more on the price. So these bonds actually lost more than your shorter-term bonds back in 2018 when rates were going up, as I mentioned. But they generated huge returns in 2019. When interest rates were going down, the rate of appreciation of these longer tenor bonds was much higher, and that's what caused their larger gains in 2019. Now, the Soldivo Bond Fund is not a tenor slice strategy. It employs a total return strategy for its holdings in government securities. Now, what is total return? Total return considers both the interest received in investing in these bonds, but also the gains and losses that the bonds experience as the level of interest rates change. So we keep the fund flexible by managing the fund based on where we think interest rates are going. That means that if yields are going up, we try to invest in more short-term bonds, just like we did in 2018. As inflation was moving higher and our expectations for yields were moving higher, we adjusted fund positioning so that it became more defensive, investing in shorter-term securities. Conversely, when we think yields are going down, like in 2019, we try to enter more of a position in longer-term bonds to try and take advantage of the potential greater price appreciation when interest rates go down and bond prices go up. So positioning can change constantly on a total return strategy. We're not going to be always in 1 to 3 year bonds, but we're not always going to be in long-term bonds as well. It's always a decision made based on the pros and the cons of the market at the time. Additionally, the fund also invests in PESO corporate bonds. Now, PESO corporate bonds are typically not as liquid as government securities. What does that mean? It means that in the corporate bond market, there aren't as many people buying and selling corporate bonds, so it can be difficult to trade them. But they serve a different purpose in the portfolio. Corporate bonds usually have a higher yield than government securities, and this allows them to increase the yield of a portfolio. Additionally, they give you the value of diversification because your investments are not just in government securities, but also split amongst specific companies which we think offer sufficient return for the risk you're taking investing in them. We typically maintain an 80%, 20% allocation between government securities and corporate securities for the Soldivo Bond Fund. So studies have shown that it's very difficult to time the market consistently over the long term. In many cases, long-term investors have been able to generate better returns than those who have attempted to actively trade the markets. This is because long-term investors are less likely to react to short-term spikes in market volatility, which tends to cause investors to buy and sell at the worst possible moments. It's always about greed and fear, and typically, the time when you're most afraid and you should be buying is actually when you're forced to sell if you don't have the discipline. Now, PESO cost averaging allows investors to view the investment from a longer-term standpoint. and constantly add to their nest egg without as opposed to worrying when to enter and exit and exposing themselves to that type of emotional stress. Additionally, for fixed income funds, the securities we hold generate interest payments in the form of bond coupons. These gains are then reinvested by the fund, allowing the fund to compound and grow further. You can avoid losing on your investment by cost averaging down when the fund is down. So this means that you're able to reduce your cost as you're buying when the fund shares are cheaper, and cost averaging up by taking profit and selling when the fund is moving higher. In this way, you're able to maintain a lower average cost overall. Fund returns are very much dependent on the specific conditions of the market at any point in time. But I will say that if you have a target return and you get to that target return, you can top slice. You can take profit on a certain portion of it. But if you continue to believe in the strategy, you continue to have a positive outlook on the market, then why not you could also just leave the funds there to continue hopefully earning for you and generating greater capital returns. As you can enter and exit the fund anytime, it's better to just leave the funds as is when you don't need the cash and take advantage of the fund's longer-term growth if you still believe in the strategy. Investment decisions should always be viewed from a risk-reward perspective. If, as indicated, the fund that you're invested in is not been performing so well and you're starting to get discouraged with the performance of the fund or no longer agree with the strategy, then you can certainly switch to a different strategy. But if you feel you have a view, and more importantly, you always have to think, what next? By selling when a fund is down or below your cost, you realize losses that, if you have no view in the market, could potentially have been made back and more had you left it in the fund. So typically, you should only be redeeming it at a loss, either if A, you have an unforeseen need for cash that wasn't predicted and you actually need the liquidity right now. B, you feel that the losses will actually continue because you have a negative view of the market, and as such, you'd rather manage your risk by taking it out of the market. Or C, if you feel that an alternative investment strategy speaks to you more and actually feels that that strategy has a greater probability of making back your losses and more, then those are all valid reasons for getting out of an investment. Otherwise, I feel that it's probably best to sit back and allow short-term volatility to pass, because as I mentioned earlier, in the long run, longer-term investors have typically been able to generate superior returns.